This is Total Growth Investing, where price growth is not enough, dividend growth is not enough. We want to identify stocks, funds, and other investments that perform well in both of these measurements, because when we find them and buy them, we can beat the market over the long term. It's late January, and everyone, I hope, is getting ready to file taxes for 2021. It's one of two things that we can't escape. The other, of course, is death. There is no night without a dawning, no winter without a spring. And beyond the dark horizon, our hearts will once more sing. For those who leave us for a while have only gone away out of a restless, careworn world and into a brighter day. Right now, the number 4 stock on the Total Growth Investing ranked watch list is Carriage Services, CSV. Carriage Services is in the consumer discretionary sector and is a corporation focused on managing, running, and supporting funeral homes and cemeteries around the United States. The corporation was founded in 1991 in Houston, Texas, and incorporated in the state of Delaware in December of 1993. It went onto the stock market in August of 1996. Carriage Services operates in 2 business segments: funeral home operations and cemetery operations. Having gone through 2 deaths in the family in 2021, seeing this stock high on my ranking list hit home for me. Both of my parents died of cancer, something I've already dealt with once myself. The deaths within the U.S. and around the world due to the pandemic have hit us all hard, and whatever we think or believe about the measures being taken by governments and societies to minimize the spread and manage the resulting impact, it has hit our funeral industry the most. An increase in deaths might seem to be a good thing for their business, but the results have been mixed. One example is what happened with Invacare in Australia, which dropped 18% overnight because the Australian government decided to limit funerals to 10 attendees right at the beginning of the lockdown in March of 2020. These kinds of restrictions happened all over. I attended my first virtual funeral for a friend in July of 2020, and I sent the eulogy for my father via YouTube just last month. The kinds of preparation and memorial services being held are changing, and the funeral industry is changing to keep up with it. According to the National Funeral Directors Association, there are 18,874 funeral homes in the United States, employing 141,000 people. That number has been coming down over the last few decades as the business end of things has consolidated. Carriage Services started talking about this in their 2001 annual report. Because the vast majority of funeral homes and cemetery management is done by private and often family-run companies, it's difficult to get solid data about the industry. Somewhere between 80 and 88% of death care is run by these small independent organizations. Service Corporation International has about 10% of the market, and Carriage Services and Stonemore have about 1% each, at least according to Statista. The annual reports of Carriage Services, on the other hand, estimate that the total for the top 4 publicly owned funeral home and cemetery corporations make up about 20% of the total market share, with the other 80% being privately owned. In annual report after annual report, I saw notices saying that they had bought or sold this or that funeral home. That's how all these companies are growing. The diversity of funeral home ownership in the industry took a major hit in 2013 when the Federal Trade Commission approved the merger of SCI and Stewart Enterprises, which were at the time the number 1 and number 2 ranked funeral home and cemetery chains in the country. Buying companies like this takes capital, and in 2022, that means debt. While researching this, I ran across a few reviews mentioning that Carriage Services has some major debt obligations coming due in 2026. That video was a few years old, so let's do an update. On May 31st, 2018, Carriage Services issued $325 million of debt, paying 6.625%, due in 2026. Then, on December 19th of 2019, they issued an additional $75 million, paying the same 6.625%. 2 years later, on May 13th, 2021, they issued $400 million of debt, paying 4.25%, due in 2029. These paid off the older notes at a lower interest rate. I don't believe that this debt is going to be a major burden because they will be able to refinance it again and again. Many companies do this, and there are many different ways and means of doing it. I found 4 different YouTube channels for Carriage Services. Some focused on potential end customers and others focused on their real customers, the owners of all of those privately held funeral homes and cemeteries around the country. Watching some of their business model presentations from 2015, I'm strongly reminded of my own employer. Turning the corporate pyramid over, considering the people at the front lines the true business owners, and then providing centralized support services for those owners. That's how they establish their business structure, and it's how they constantly refocus on the end goal, which is providing the best services to the end customer that they can. I found this snip from one of those videos that I want to share.
Let's talk about decentralization and partnership and put some meat on the bone. As I looked at the organizational structure, like a triangle, I took the structure and I turned it upside down and shook it out until everything was gone that was stupid and out of alignment.
Let's take a look at the numbers that brought Carriage Services to the top of my ranking list. Their 4-year average dividend yield is currently at 1.28%. And for anyone who purchased the stock at the low points in 2000 and 2009, your yield on cost can get above 25%. We are right now at a high point in the stock price, so it might take a long time to get there. However, as we can see from the dividend growth numbers, that might actually be possible. If we use TradingView's data to see the full price history going back to 1996 when they launched on the stock market, the stock in the late 90s dropped down to the single digits thanks to the dot-com crash, and then went that low again in 2009 after the financial crisis. But returns always depend on the timing of when we get in and out. If we take a date range from 2009 through today on Portfolio Visualizer, we can see a compounded annual growth rate of 28.99%, and a portfolio of 10,000 starting in 2009 would now be worth $279,442 and would be earning $2,279 per year in 2021. Their dividend growth rate has been on an upswing as well, enough to register in my ranking calculations as one of the best out there, and their total return over the past decade is currently sitting at 836.96. There are new people joining the various investment groups that I'm involved in every single day, and it's great to see. I can't say enough about just how important it is for everyone to be saving for their future. According to a survey that was done by the website Go Banking Rates in November of 2019, 69% of Americans have less than $1,000 saved. And for 45% of us, that number is actually zero. Having gone through one death in the family, where the end was not planned at all, leaving us scrambling to pay for funeral homes, cremation, burial, I can't emphasize enough how important it is for our families to at least have those expenses saved up in case the worst thing happens unexpectedly. Unlike many of the other investment YouTube channels, I don't focus as much on the detailed numbers like earnings per share, etc. I do look at them and I use them to gauge whether I should buy a stock or a fund, but there's all kinds of places to get that data, and I want to encourage you to go to Seeking Alpha, Morningstar, or the research pages of your broker to find those details that you care about the most. I see that my own broker, E-Trade, rates CSV as a strong buy according to tip ranks and a few other research sources. What brings stocks like this to my attention is my ranking list. So I think it's time for me to update the numbers on my top 10 and see what stock is going to be the next one for me to research and storyboard. And this will give you a chance to see how I do this. This is my data entry sheet, where the raw data from Seeking Alpha is updated and recorded so that my calculation sheet can do the work to figure out what the actual rankings are. I work this sheet oldest first, and you can see I'm about 6 months behind. This is not a dynamic process. I don't automatically pull data from any source, mostly because I don't want to pay for those sources. If you're interested in a fully dynamic version of the ranking system, the website Dividend Scouts is where you want to go. They get updated data on a daily basis. And this is where I get the raw data. Seeking Alpha, it's just a free login account. With the way my system and strategy works, I don't need to go any deeper than the data they provide for free. Remember, the TGI list is not a buy list, it's just a watch list. I always do my due diligence on any stock before I buy a share at my broker. A good example is the top-ranked stock on the list right now, Direxion Daily Technology Bull 3X Shares ETF, TECL. I did a video on that last month explaining what it is, why it is at the top of my ranking system, and why I don't think it's a good stock for me to buy right now, because of the risks associated with leveraged funds. Always dig in and understand what a stock is before you buy it. So my objective here is to update all of the numbers and get a top 10 that is updated to today's date. I sped this up 5 times and it's still 5 minutes long because this took me about 20 minutes to do. Let's see. You can already see TECL is dropping down. ITB is going to be making some changes. Down to 81. CSV, the one that we're working on now, is dropping down to 64. Let's see. VRTS, I think, dropped down a little bit. Yeah, down to 13, 14. Old Dominion Freight Lines jumped up to number 5. BBF stayed at number 7. AGM dropped down to 22. And ASM International dropped down to 42. So let's see how they look. Okay, so the top 5 are still there, but let's keep going because I want a full 10. There's a semiconductor ETF. Sometimes they provide the payout ratio, sometimes they don't, and I don't fight it. It doesn't change things all that much. But that dropped SOXX down to 41. EGT, which I did a video on early on, dropped down quite a bit actually, down to 199. Even Eagle Materials dropped down a little bit, and I only added them last week, down to 27. TMO down to 19. Qcln stopped paying a dividend. The last dividend was in June, so I gotta zero that out until that dividend comes back. Let's see. Louis Vuitton. Dropped down to 103. Qcln has been hit because it's tech related, and we've seen tech take a dive over the last couple days. Down to 472. Applied Materials, another semiconductor stock, down to 59. And one more, Louisiana Pacific. How did that hold up? It stayed at number 8. Great, we have our new top 10. Thanks for watching. As always, if you liked this video, please hit the like button and subscribe to the channel. Based on those updates, the next stock for me to research is Walker & Dunlop, WD. That's a real estate financial service company out of Bethesda, Maryland. I'll be doing that research over the next few weeks. Along with this YouTube channel, please also like the Facebook page, and if you'd like to talk about the TGI ranking system and any of the stocks at the top, please feel free to join the Facebook group. I do these videos for fun, not profit. The profit comes from making good choices in investing and watching the returns roll in. Let's beat the market.